Hi. Today we're gonna discuss about the balance sheet. A balance sheet is a statement of the assets, liabilities and equity of an organization at a particular point of time. The balance sheet can also be described as a particular record wherein the organization could determine their financial condition or status. A balance sheet is comprised with three distinct parts: assets, liabilities, and owner's equity. Wherein the total assets minus the total liability is equal to the equity of the organization, also known as the capital, net worth or net assets. Assets. Assets is any item of economic value owned by an organization, especially that which could be converted into cash. The assets is broken up in two sections, current assets and fixed assets, wherein when they're added together, the sum is called total assets. Current assets. Current assets are all assets that a person can readily convert to cash to pay outstanding debts and cover liabilities without having to sell fixed assets. Current assets include inventory, cash, marketable securities, accounts receivable, prepaid expenses and other liquid assets that can be readily converted to cash. Fixed assets. On the other hand, fixed assets are usually buildings, real estate, equipment and furniture, which are assets that cannot be readily turned into cash in a short amount of time. Liability. Liabilities are companies' legal debts or obligations that arise during the course of business operations. Liabilities are settled over time through the transfer of economic benefits, including money, goods or services. The liabilities is broken up in two sections as well, current liabilities and long-term liabilities, wherein when they're added together, the sum is called total liabilities. Current liability. A company's debts or obligations that are due within 1 year. Current liabilities appear on the company's balance sheet and include short-term debt, accounts payable, accrued liabilities and other debts. Long-term liability. On the other hand, long-term liabilities are debts that the organization is obligated to pay with a period of more than a year and usually repaid by installment. Long-term liabilities includes long-term bank loans, loans for mortgages of equipments, building, land or even a car or trucks. Equity. Equity is the capital invested by the owner or owners of a company, where some organization are owned by stockholders, so equity is sometimes also referred to as stockholders' equity. Equity represents the net worth of the organization. What is the importance of balance sheet? A balance sheet summarizes a company's assets, liabilities and owner's equity, net worth, at a specific point in time, usually at the end of an accounting period. The purpose of a balance sheet is to give users an idea of the company's financial condition along with displaying what the company owns and owes. It helps business owners quickly get a handle on the financial strength and capabilities of their business. Balance sheets, along with income statements, are also the most basic elements in providing financial reporting to potential lenders such as banks, investors, and vendors who are considering how much credit to grant to companies.